If you're watching markets closely, you probably felt this one in your gut. I'm talking to you, the person who doesn't just look at prices but asks why. Hit pause on whatever you're doing and stay with me, because something just happened in silver that doesn't happen often. In a single day, silver futures collapsed 34%, 34 in 24 hours. At the same time, nearly $1 trillion evaporated from gold markets. And here's the thesis you need to hear right now. This wasn't panic, it wasn't random, and it definitely wasn't the end of the silver story. The real trigger is hiding in plain sight, and once you see it, you'll never look at commodity crashes the same way again. If you're holding silver right now, if you're watching this space, if you're trying to understand what the hell just happened, your job is to understand the mechanics, not just the headlines. So let's do that. Before I explain what caused this, let me teach you something most investors never really internalize. When you see a price on your screen, you assume that's the price of the thing itself. But in metals, especially silver, that's often not true. Think of it like airline tickets. The price you see online is a promise to get a seat later, not the seat itself. It's a contract, a claim, a piece of paper that says you're entitled to something. In silver, the US benchmark price comes mostly from paper contracts traded on COMEX, not from people actually handing over bars. Meanwhile, in places where physical metal changes hands every day, like the Shanghai market, the price reflects what buyers are really paying to get silver now, today, delivered to their door. When those two prices start drifting apart, that's not noise. That's information. It's telling you that the market for promises and the market for actual metal are under different pressures. And when that gap gets wide enough, something's got to give. So what does that tell us? It tells us we're not looking at one market. We're looking at two markets wearing the same name. And understanding that split is the key to understanding what just happened. Now here's what's actually happening. And this is where it gets real. On paper markets, silver was trading around $92 an ounce. At the exact same time, physical silver in Shanghai was changing hands closer to 120, even 130 in some transactions. That's roughly a 40% premium for real metal. Let that sink in for a second. Two prices, same metal, same moment, different realities. This happens because the paper market is massive compared to the physical supply. Estimates put the paper to physical ratio around 350 to 1. That means for every ounce of real silver sitting in a vault somewhere, there are hundreds of paper claims floating around the financial system. So when silver becomes a crowded momentum trade, big players don't need physical metal to move the price. They just sell contracts, fast, hard, in size. And here's how that cascade works. When silver ripped more than 60% in January, leverage piled in. Futures traders chased it. Retail momentum hit. Stop-loss orders clustered at certain price levels. Margin requirements expanded as volatility increased. Traders were holding positions on borrowed money, and when you're levered up, you're vulnerable. Then the trigger hit. Heavy contract selling slammed the paper price lower. Once silver broke through key technical levels, automated stops cascaded. Margin calls forced liquidation. Traders who were up big suddenly had to sell to meet their obligations. And suddenly you had the largest one-day drop in silver futures history. But here's the part that should make you nervous in a good way. None of that selling fixed the underlying physical tightness. Premiums didn't collapse. They stayed elevated. Shanghai dealers weren't suddenly flooded with metal. Delivery times didn't normalize. Coin dealers in the US weren't cutting prices. That divergence, that split between what paper did and what physical did, that's the stress fracture, not the resolution. Now let me show you what very few people are talking about. The mechanics of this move tell us something critical about market structure. When you've got 350 paper claims for every real ounce, the paper market becomes a price discovery mechanism that's detached from supply and demand fundamentals. It's driven by leverage, positioning, and technical levels. So when a leverage flush happens, it doesn't mean demand disappeared. It means traders got shaken out. The people who wanted metal to hold it, they're still there. The people who were trading momentum on 5-to-1 leverage, they're gone. And that's a feature, not a bug. Markets do this. They purge weak hands. They reset sentiment. They create opportunities for the next phase. This is the exact same playbook we've seen before. Zoom out and you see it clearly. In 2011, silver went parabolic. It hit nearly $50 an ounce in April. Paper leverage exploded. Everyone and their cousin was buying silver futures. Then came a violent correction. In 5 days, silver dropped 30%. Sound familiar? That shakeout didn't kill physical demand. It reset the trade. Silver bottomed, consolidated, and the fundamental story around currency debasement and industrial demand continued. Fast forward to 2020. When silver became a crisis hedge during COVID, futures volatility spiked again. Paper markets went wild, but physical coins and bars went no bid at posted prices. Dealers had inventory, but premiums shot up to $8, $10, even $12 over spot. You couldn't buy silver at the COMEX price. You paid what the physical market demanded. Every time this setup appears, heavy leverage, paper dominance, physical premiums, the paper market breaks first. And here's the pattern. These breaks don't end cycles, they reset them. The 2011 correction didn't kill the silver bull market that started in 2008, it just chopped out the tourists. The 2020 volatility didn't end the physical squeeze, it highlighted it. So when I look at what just happened, I see a mechanical event, not a fundamental shift. The story didn't change, the structure did. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this just be a speculative blow-off? Absolutely. Could claims of price suppression or manipulation go too far? Yes, they can, and often they do. Markets don't need villains to function. They just need incentives. And the incentive structure here rewards paper liquidity over physical delivery. Exchanges make money on volume. Traders make money on volatility. Producers hedge risk. Investors speculate. None of that requires conspiracy. It's just how the system works. So instead of arguing about motives or who's pulling strings, focus on signals. Are physical premiums collapsing back to normal? Are inventories rebuilding fast? Are delivery times normalizing? Are dealers cutting prices? That's what actually matters. And right now, those signals aren't screaming game over. They're screaming tension. So yeah, be skeptical. Question the narrative, but also respect the data. There are probably three types of people watching this right now. If you're a short-term trader, you're probably asking whether this is tradable chaos or stay-away risk. I get it. For you, volatility is the asset. You make money on moves, not on being right about fundamentals. Here's my take for you. This kind of mechanical selling creates opportunities, but you need to respect margin mechanics and size small. Don't hero trade this. Don't try to catch the exact bottom, wait for stabilization, watch for volume patterns to shift, and if you're trading futures, understand that you're playing in a levered algorithmic environment where stops can cascade fast. Your edge is patience, not prediction. If you're a long-term silver bull, this drop probably felt brutal. Maybe you've been stacking physical. Maybe you've been holding mining stocks. Maybe you bought near the top and you're watching your position bleed. I get it. For you, the question isn't price today. It's whether the thesis is still intact. And here's what I'd tell you, watch premiums, not headlines. If physical premiums stay elevated, if you still can't buy coins at spot, if Shanghai keeps trading 30-40% higher than COMEX, that tells you the physical market hasn't broken. The paper market flushed, but the underlying demand is still there. That doesn't mean it goes straight up from here. It means the story isn't over. And if you're new, if you're just trying to learn and understand how markets actually work, here's your takeaway. Whenever you see a violent move like this, ask whether it started in paper or physical. Did real metal move or did contracts move? That one question will save you years of confusion. Because paper can flush fast, physical moves slow. And when those two diverge, you're seeing market structure, not market truth. Here's where I stand. I'm not bearish silver, and I'm not blindly bullish either. I'm watchful. Let me tell you what I'm personally watching. First, I'm watching the spread between paper prices and physical premiums in Shanghai and Asia. If that gap closes fast, it means the physical tightness was overblown. If it stays wide or widens further, it means the paper flush didn't resolve anything. Second, I'm watching futures open interest to see if leverage actually flushes out or if it rebuilds quickly. If open interest drops and stays low, that's healthy. It means the froth is gone. If it bounces right back, we could see another volatility spike. Third, I'm monitoring how fast confidence returns after the dust settles. Are buyers stepping in at lower levels? Are mining stocks stabilizing? Are physical dealers restocking? Based on my analysis, this event was mechanical and technical, not fundamental. The fundamental picture around industrial demand, monetary uncertainty, and physical supply constraints hasn't changed overnight. Silver is still used in solar panels, in electronics, in batteries. Central banks are still buying gold. Governments are still running deficits. None of that reversed because futures traders got liquidated. What changed is sentiment and positioning. And those things reset fast. Now, if history rhymes and physical premiums stay elevated while paper positioning cleans out, the move that follows could be significant. I'm not predicting it. I'm saying the setup would be there. Because once leverage is out, once weak hands are gone, the market can move on fundamentals again. And if those fundamentals are tight supply plus persistent demand, well, you do the math. I'm not a financial advisor. This is not financial advice. I'm a market observer showing you how to interpret what you're seeing. Do your own research. Make decisions that make sense for your situation, your risk tolerance, your timeline. Don't trade based on one video. Don't bet the farm on someone else's thesis. Think critically, verify the data, stay sharp. If you made it this far, you're the type of person who doesn't just react to headlines. You dig deeper. You ask questions. You want to understand the mechanics, not just the story. That mentality will serve you well, not just in silver, but in every market you watch. So here's what I want from you. Drop a comment and tell me what you're watching. Are you looking at premiums? Are you tracking inventories? Are you trading the volatility or holding for fundamentals? Let's build a community of people who think independently and share insights. If this breakdown helped you see the bigger picture, share it with someone who's trying to make sense of what just happened. Hit subscribe if you want more analysis like this, where we go past the surface and look at structure, mechanics, and patterns that repeat. Stay sharp out there. Think critically. And remember, in markets like this, understanding how the game is played matters more than predicting the score. I'll see you in the next one.